Tom, redefining your market. There is no better example than financial services today. The market isn't the same. The benefits you offer are rapidly changing, and the market segments you serve are being redefined in real time. Now, Tom's unique, and he's gone from $2 million to $3 billion, and his goal is not to go back to $1 billion. But he wants to grow another billion-dollar business. So, Tom, give us your insights.
Well, I would tell you we essentially have two groups of clients. We have the ultimate client, the investor in the marketplace, and we followed a principle that basically said the industry was outmoded in the way it sold. It sold securities and bonds like products rather than to fill customer needs. So in today's business school speak, you would say we were customer-driven or client-driven rather than a product-driven company. And we use financial planning to actually do the inquiry with our clients to determine where they wanted to go, what their risk tolerances were to reach their objectives. And we then would fulfill all that after we did the plan with investments. So the whole concept was that our business was you and your financial well-being. And, you know, I think you have to have a monomaniacal focus on your objective to be successful and to be one of these billion-dollar companies that you're describing, David. I think it's not an easy task. A lot of our people here are very driven and optimistic, but you have to really be good at this to get it done. Well, I think we've lived up to our commitment to clients, and we won J.D. Power's rating for the highest customer rating last year in the financial services industry because our clients think we put them first. But probably the most unique thing that we did is when we came out of a time like this not very long ago, in my mind, 73, 74, we didn't have any money left. We were lucky to have survived, and we wanted to grow. We believed that growth was a very important part of our own culture. And so we decided to essentially adapt the franchise concept to the securities business, and we began to add independent contractor offices all over the United States. And that essentially allowed us not to make the capital expenditures that you have to make to open offices, to hire salespeople. They made those commitments. Therefore, they had an investment in themselves in terms of their business. So they were more careful about the quality of service that they provided. And we only hired people who had very good track records historically in the industry. This was not training new people in the independent contractor model. This was all experienced salespeople. And that allowed us to grow out of these very difficult times at very rapid rates. When we decided that entrepreneurship was really saleable to security salesmen, we began to actually draw not just financial planners into our network, but to attract from wirehouses. And we built a nationwide distribution system through these independent contractors. And then we said, look, if you can affiliate people through independent contractorship, and they're really doing pretty much the same kind of planning you're doing in your employee model, why don't you somehow provide that to financial institutions? And we began to actually provide, we call it our financial institution division, and we provide those independent contractors or manage employees for banks, and we do all their securities volume for them. We said, gee, you know, recently, this is more recently, 10 years ago, that investment advisors were becoming a more important part of the business, and that was a fee-only model. So we created a fee-only model that we recruited people to, essentially, in the business. Again, using the same skill sets, the same products, different pricing. We had already moved in 1974 to wrap fee pricing because we believed that customers wanted to feel their financial advisors on the same side of the table with them. So if you go through a period, as we've been going through, where people lose 25 or 30% of their net worth in the stock market, the financial advisor feels it too, and vice versa. you take part in the overall growth with the client. And that enabled us to build this new investment advisor division. So we consistently built new affiliation options. We even tried discount brokerage so that we could reach a larger client base in a shorter period of time. And we did that through bad markets, good markets, really didn't matter. So distribution was one of the key factors in terms of our developing a model that would grow controlled growth. One of the things that you took for granted there, Dominic, was that you didn't use up that capital resource and that you didn't put the business at risk by taking risk that really you shouldn't take. Because even if it's 0.5%, you don't want to put your business at a risk in a time like today when you don't know if the bank is going to renew your credit lines. Certainly true in the financial services industry today. So we have been very careful from those lessons in 73, 74, the lessons that some of you, younger entrepreneurs, are learning for the first time. That I want to tell you, you don't want to experience this yourself to learn. You really would rather learn from your peers that have been through these times and protect your business so that you ride through these tough times. So I would tell you, spend a lot of time on risk management. It's extremely important. It's not as important as the client relationship is. It's not as important as the sort of prime directive of the business. But if you don't have it, you're never going to make that $1 billion number.